We are live. I'm gonna put you on mute. 1 second, Doc. Hi guys, good to see you again. Please let me know if you can hear the audio okay. Let me know if you guys can hear us. You can, you can send us a message here in the chat. Great. All right. So before we start today, we're going to talk about option selling. We're just going to add our disclaimer for just a few seconds. All right. So first of all, we were live 20 minutes ago, and for those who have been part of that meeting, we really thank you for your time. For those who basically have missed the meeting, we basically have introduced new models and gave you some examples on how to use them operationally. We now have term structure, skews, net delta exposure, swing trading models, and basically in the webinar today, we're going to show you some examples, some use cases. We also have some new integrations, NinjaTrader, MetaTrader, TradingView, Sierra Charts. We also have a new academy, a new membership, a new website. So there's a lot of things that we covered. But during this webinar, we're going to switch things a little bit. So first of all, we just want to remind you that, we're live today. We're going to be live tomorrow. We have a technical analysis webinar on Friday, and then we're going to go back live next week until the end of the month. So first of all, again, this is some of the things that we've developed. But today we're going to talk about option selling, and Doc, aka Paul, I don't know which one you prefer, Doc, but basically is one of our traders within the community. He runs our structuring channel. And every day, really, he looks at the data, at the Q models, and he really wants to show you how you can use them to then look at strategies and look at how to read the market. But before we go into that, let's go and discuss what option selling means, right? So why is option selling very important? So when we sell an option, we collect a premium. And there are two ways of selling options. One, you can sell a call, you can sell a put, or you can do more complex strategies where you sell a spread. And that is what Doc is going to also talk about it today. When you sell an option, obviously if you sell a call, you're giving the buyer the right, but not the obligation to buy the underlying asset from you at a specified strike price, right? If you sell a put, you're giving the buyer the right, but not the obligation to sell the underlying to you at a strike price before the option expires. What is the advantage of selling options? First, generate income, potentially generating a steady cash flow. And Doc is going to go into more details about his strategies. It's all about selling. It's all about premium. So we're going to hear from him very soon. But what is the risk of selling options? Obviously, there's a lot of risk. If you sell call options naked, your potential risk is unlimited. If the company and you sell a put option and the price drops, you could incur in heavy losses. Again, but there's also some key advantages, right? The first advantage is you can benefit from volatility. And today we're going to show you how you can do that. You can benefit from the option Greeks, and you can also benefit from the ability to calculate your risk before you do that. So using spreads can help you calculate your risk. So now, Doc, I'm going to pass it on to you. And if you tell us a little more about, your experience, for those who don't know you, what do you do? And then let's look at some examples.
Okay, hi, everybody. The screen name that I use is Doc McGraw, given to me by a former mentor based on the cartoon character Quick Draw McGraw, because I was always quick on the draw to get into a trade fast and get out fast. That's what the McGraw comes from. I don't have a camera because I'm on my trading computer that in my infinite wisdom, I decided it should be slimmed down and not have a camera, so I apologize for that. Okay, so I don't know. I'm going to assume that some of you are here because you're familiar with selling iron condors or selling SPX 0 DTE options, which has kind of become all the rage. So I'm going to talk about that a little bit. I'm going to share my screen, then I'm going to get into the new models. So, Fabio brought up a model. So, as Fabio explained, selling options, and I'm just going to assume that most of you know what selling options are. If you don't, you can ask more questions. The way I like to think of it as it's a hand grenade instead of a sniper rifle. I just have to figure where the underlying is not going to go, not where it's going to go. It's a lot easier for me to exaggerate SPX's 5644 now. Pretty sure it's not going to 5,000 or to 6,000 today. Okay, now I can't get anything for selling that option, but that's just an exaggerated idea. Now I'm going to see if I can, I'm not the most technologically savvy guy around, but I'm going to see if I can share my screen and we'll kind of get started here. Share screen. I think this is what I want to share. Okay, yeah. So what I'm showing you right now is every day in MenthorQ, you have these trading view scripts that show you the levels for the day, and I do a little write up, a game plan for the day that's good for option sellers or buyers, where we expect it to go or not to go. But just looking at this model here, the calculated expected minimum move was 55.93. 5,600 is the large round number, which we all know. Up on top, 56.50, where we're kind of getting pinned, where we're kind of getting stuck. And then here's the maximum where it's expected to go, and these levels are over here. And so what I would do as So what I would do as an option seller is I would look to sell above these levels, calls saying that's not going to get there, and puts below these levels, which is actually what I did today, and I put the trades in the chat there. And usually I like to put in a closing order. So if I sell a spread for 50 cents, then I buy it back for 15 cents, keep a third of the money, and get the risk off the table. Now, I'm not sure how familiar most of the people are here for selling spreads. You guys see my my screen okay? Fabio,
Yep.
am I streaming the right thing? Okay.
Absolutely.
Okay. So that's the basic idea of selling options. I try to sell it where it's not going to go. Now, also this model, if you look at it, also showed us levels to take trades off of. So usually the trades go level to level. So from level 2 to level 3, we get a trade. We overshot this level almost to the maximum level. So a reversion trade would also make sense. And you see here how we have these two levels clumped together, which tells us that there's going to be a lot of market maker hedging activity there, and that's kind of where we're going to stall, which is kind of where we did stall. So just a little bit about how I saw the options today. I looked to sell. Once we started going up earlier in the day, getting to this 50 level, I looked to sell calls first, assuming that we were going to go up and stall, which is what happened. Then on the pullback, I sold puts. So that's just to get a better premium. But even if I had done them both at the open, these would have been fine. Now that's the 0 DTE model. MenthorQ Fabio has now introduced a new swing model, which rather than giving just the 0 DTE levels, these are the levels based on market makers' hedging obligation based on today's 0 DTE options that expire today. I'm going to also assume that you have a somewhat of an understanding of gamma, which is the rate of change of delta. So as time to expiry gets closer and closer, market makers have to hedge their deltas more and more related to the 0 DTE options. However, they also hedge their whole book, which brings us into the swing model, what they're exposed to. So let's see. This content is no longer available. Great. I'm on the wrong screen. I gotta go to a different screen. So hold on.
Yeah, and I can share that out.
Let me switch screens here.
And if you guys have any questions at any point, please, again, type them in the chat here. We're going to do a Q&A as well at the end.
Okay, I think I got the right one this time. You see, that's a 1 month skew of IWM, which we'll talk about later for fun.
Yeah.
But let's start with this. Oh, I might as well show you this while we're here. So in the morning, we do a little open mic on the voice chat where I go over the levels for the day, not just SPX, but some of the main stocks, Nvidia or Apple. And if other people have other stocks of interest, we kind of talk about those as well. So somebody in the room had talked about oil and gold. So here he took the MenthorQ levels and he kind of colored them the way he wants to color them. And we talked about those levels for today. So this is a screenshot of what we were talking about this morning in the chat. But that's not what I'm here to talk to you about. I'm just kind of giving you a couple of the benefits. Okay, so here's the new model, the 5-day swing model. So what this model is telling us, go ahead.
Sorry, I don't think we can see a screen. We can only see the 1 month skew.
You see the 1 month skew. That's weird. Okay. I'm not sharing the right screen. That's the 1 month skew. You're right. I'm sorry, guys. Let me try. Is this gonna be it? Nope, that's the wrong one. Fabio, maybe we can use your you can put it up and.
Yeah, let me just get it up 1 second. All right, yeah, so we can in the meantime give a demo of the platform too. What do you want to add, Doug? Sorry.
Okay, well, right now I can't tell. Am I sharing my screen or not? I can't tell what I'm doing here. Stop sharing. Okay.
Yeah, so I'm gonna use my access. So yeah, just let me know what you would want me to show.
Okay, I can no longer see the screen for some reason. I'm sorry, guys. Technical difficulties here.
Can you see my screen here? Oh.
Okay, I found it. Okay, so let's just put up the 5-day model.
Yeah, so to do that, so that we can give a live demo in the meantime, you can type in the command swing is the code for the model. We can type in either 5 days or 20 days. Which ticker do you want, Doc?
Let's just pull up SPX for starters. Okay, so there you go. Okay, that's easier to see. So what this is a 5-day model. So if you want to take a swing trade, a 5-day trade, call it for Friday or for Monday, 5-day-ish, it's telling you what the levels would be that I would be interested in selling. And so if you see to the right, it says lower band 55.45. So that's indicating that 55.45 level, below that level shouldn't be breached. So I would look to sell an option 55.45 or lower a week out, say for Friday options expiration day or for Monday. And if you look at the swing model success rate, the very bottom line where it says success rate 94.26% on 35 days. So for the last 35 days that this model ran, each day starting new, a new occurrence, 94.29% of the time the model was successful. Now, if you go up the next one, the lower band, success rate was 100% last 32 days. So for the last month, if you sold options at that level or below it, 5 days out, it would have been a winner.
Yeah, and now, I think if I can add something to that, so that's when the directional bias comes into the model, right? So either the lower band or the upper band can help you define the kind of direction where overall the market should not go. So again, no model is 100% right. There's no way we can know where the price can be in 5 days, but we're using data, machine learning, and a lot of information to kind of derive these levels.
Okay, now I want to point something else out. Although the upper band has been pierced a number of times, let's remember that it's been pierced and pulled back. So those would have been losers had I sold those calls and sat there like a deer in the headlights and waited for them to get hit. Typically, we like to sell above and below the key levels, not at the key levels, adding a cushion. Also, typically, we like to put in a buy to close order at 50% profit target. So if you sell it for $100, buy it back at $50. And with that kind of risk management, the success rate would be much higher. We don't have the statistics, and you would have a chance to get out sooner. But this model is telling us that right now, selling puts is what's working. And so we just kind of stick with what's working. So on the 5-day, that's what you would sell. Now, if we look at a 30-day model, or a 20-day model rather.
Yeah.
And Fabio's going to run that one. Then that gives us a better idea of where we could sell 20 days out, and we'd be selling below where that green line is. Now, I also want you to notice that the upper bands also give you a target of where you'd be trading if I'm going long. If I'm going long, I'd be shooting for getting to the upper band. Now, also, if you can pull up, let's just say SPX Skew. Now, what the Skew is showing us is how the volatility is being priced, how the IV, or the price on a 25 delta risk reversal. So that's, if you compare the price of puts and calls, how that's being priced. And if you're looking, let's say, you see that big hump at July 2nd, okay, where the mouse is, that's showing us that calls were overpriced, or people are overpriced relative to equidistant puts. So there was a strong demand for calls. And so that's telling us that the market wants to go up. Right now, if we look at where the risk reversal model is, it's kind of in a normalized range. Puts and calls are kind of relatively fairly priced. So the demand for calls is kind of waning. And that's just showing the model going out 1 month. Now let's take a look at Nvidia, stock that everyone likes to trade. 5 days. Let's see what the model is showing us. So the model is showing us lower band 119, 137 upper band, and you look at the success rate once again, 93% on the lower band, upper band success rate has been 0. So once again, we know this is not a time to sell calls on Nvidia.
And Doc, if I can add something. So
please, because this is your model. I just was introduced to it yesterday, so I'm still working out the kinks.
Yeah, absolutely. So first of all, there's some really good question here. So let me add them to the chart. So Scott, thank you for your questions. Where is the upper band on this chart? So as we explained in the previous session, the model has 3 levels: an upper band, a lower band, and a risk trigger, right? And you only will have either an upper band or a lower band. So there will be never an upper band and a lower band. And that's kind of like where the directional bias comes in. So whenever we see a lower band, there is a bullish directional bias. When we see an upper band, there is a bearish directional bias. The risk trigger level is kind of like a volatility measure that is up there, but it could be when the price reaches that level, it could be that we are trending, and therefore we can see an increased volatility. So the model really actually doesn't calculate the risk trigger, and as you can see here is really 6% success rate. So the price always closed above that. But what we want to look at is the swing model success rate that calculates the upper band and the lower band. So in this case, the success rate is not 0. Is really that we never had an upper band on those 35 days. So it's always been a trending environment for Nvidia in this case.
And I would think of the risk trigger almost like a profit target, or almost like the ultimate destination where it could go, or the ultimate destination where it probably shouldn't go. So being a little aggressive, which I've been known to be, I might look at selling puts below 119 or 120 and calls around 140, seeing what kind of premium I could get and playing with it that way. I also looked for a long bias toward 135. And I'm actually in some Nvidia long, call debit spreads and butterflies.
Yeah.
And so this is telling us Nvidia shouldn't go down to 120 within the next week, give or take. Now let's look at a 20-day model of Nvidia, which takes us kind of into the August expiration. Okay, so now here the bands are stretched because more time, more room for an underlying to move. And here we have 110 the lower band, 146 the upper band, the risk trigger, which is basically the all-time high. So once again, I would either be looking to sell puts below there and looking for a long trade toward that upper risk trigger, toward that upper band. Now, one of the things that I like to do while we're on Nvidia, let's pull up a risk reversal and a term structure. Okay, so what the risk reversal model is showing us there, once again, you see where those green peaks are, yeah, over there. That's where there was kind of, let's call it crazy call demand, where calls are overpriced. So while the stock is going up, we would expect a reversal there. One could also sell premium out of the money on overpriced calls, and even if the stock continues up, it tends to go down, and you have the ability to get further away. And we see the next day or the next week, it went up and reversed. If we look at the price on top, look at the price, yeah. See what happened up on top there? We had the call skew. They were buying the calls. As the call skew started going up, the demand was there for calls, and then price, then the demand went down and price went down with it. Now we just kind of see the call skew sort of trending, trending flat, but that's still relatively more demand for calls than puts. Now, if we pull up the term structure, it was something interesting. I was looking at it this morning. So the term structure is showing you how puts and calls are priced over a time, or over a time, period. Term is just another word for time. And you see the green is over the red. So there's more demand for calls and puts in Nvidia. Not surprising. So the stock still has a bullish bias, which makes me feel more comfortable selling puts or buying calls. But we also see, if you look at the shape of that, if we go in toward today, if you get to the left, if we go in toward today, all the way to the left. There we go. If we go in toward today, okay, so that's the volatility for this Friday. The closest expiration of volatility is always going to be higher. Then it kind of trails off, the demand for calls trails off as we move to the right. But then we see that big spike in call demand over there, which is probably heading toward earnings. That looks like an earnings spike. So we see people are still bullish Nvidia into earnings. So now if we put this together with earnings coming up and call demand, with the 30-day swing model pointing us towards was 140 something on top on the 20-day, and about 137 on the 5-day, those would be targets. I would look to get in around here, 125-ish, whatever, and buy a call debit spread, where I'm buying a call and selling an out-of-the-money call to get the premium, selling it where it's not going to go. And that's kind of how I would look to trade with this. Something interesting, if we pull up IWM, let's do a few models on IWM. Now I'm guessing a lot of you have notice that IWM, the Russell 2000, has blasted off and has been relative strength. Basically, once the CPI and all the numbers came in good, and the rate cuts seem to be a when, not if, and they look like they're sooner rather than later, we see that IWM took off, and now we have a lower band of 211. So looking at that, it would be safe to sell puts down at 210, or we have an upside target of 223, which is basically where we're at. So it's kind of looks like IWM is at its destination for now. If we pull up an IWM term structure, which I looked at this morning, I thought it was interesting. And we tend to talk about these things in the morning open mic. If we look at the term structure there, you see that kink around 20 days, a little bit further in, further to the left. Yeah, that's around the FOMC day. So it looks like people are bidding up calls into the FOMC, expecting a dovish bias. Are they right? Are they wrong? That's not for me to determine. That's what the market's saying. That's what the algos are saying. So that just gives us a feel for what's going on in IWM and gives us a feel for the tone of the market going out into time. Hold on one second. Let me mute my phone. Let me turn off my phone. Fabio, you can talk for 1 second.
Yeah, absolutely. So I'm going to answer a couple of questions. So let's pull up Paulo. What are the inputs for the calculation of the trigger and bands? Similar to the expected daily move. The principle is similar. So basically, the goal of this model was really to allow people that are not actively, in front of screens every day to have an idea where the price of an asset could go further in the future. So the idea behind is very similar to the one-day expected move, but we have added some additional data points. So we've added a lot of like the Greeks that we have, gamma, delta. We've added momentum. We've added like some advanced option models. So there's a lot of data that goes into the model to be able to give you those levels. So yeah, I hope that answered the question. Then I have George. Which stocks have data for the swing trading models? As of today or as of tomorrow, you will get access via the bot to about 900 stocks, and the swing model will work on all of them. So the swing model is working right now on indices, ETFs, and stocks. In the future, it will also work on futures.
And let me just say a word about, let's just say hypothetically, why is it 900, not 2,000? And correct me if I'm wrong, for the model to have good predictability, there has to be a threshold volume of options, a threshold amount of notional traded compared to the value of the stock for it to be predictable.
Yeah.
So just to exaggerate, if there's a stock that's got 10 calls and 3 puts, there's nothing there for the market maker to hedge, and so the model is going to lose predictive value. Yeah. Now that's an extreme version, but there's some relatively liquid stocks or ETFs that just don't have a lot of put and call activity for whatever reason. So for that reason, Fabio and his team and the developers screen out those where the model will have less predictive validity.
Yeah, and I'll give you an example, Doc. For example, we provide gamma levels on futures, right? And YM, which is one of obviously Dow Jones future a lot of people trade that, but there's no option activity there. So we don't cover it, not because we don't want to or the model cannot access that, but there is really no options because I think the way the future is set up. So in that case, yeah, we don't have the coverage there, not because we don't have the data, but it's just that there's no really valuable data that can give you like really good information and good predictability. Yeah, correct.
Yeah, so the 900 stocks that are screened, there's going to be some predictability. Now, obviously, hopefully it's obvious, stocks like things like the SPX, the index, names like Nvidia, Tesla, Apple, names that have a lot of options value. And actually, Goldman had a note that we mentioned about the notional value of some of those names, Nvidia, Tesla, Apple, etc., into this expiration was close to off the charts. And so what that means from a gamma point of view is we have more predictability. We know where those levels are and what the market maker's hedging obligation is going to be. Do we have any questions? I'm really not sure what people are interested in hearing, what they know or what they don't know.
I'm going to ask some questions. So question from Eurico. Yeah, 5 days and 20 days is trading days. That's correct. So very important.
And a word about 5-day and 20-day. If we think of the weather report, I could probably more accurately predict the weather today than in 5 days than in 20 days. Similarly, the model, the closer in you are in time, the more predictive ability there is, the tighter the ranges are going to be. 20 days out, something could happen in a week. We don't know what's going to happen. Also, around the largest expiries, around the monthly options, is where it's going to have the most predictive validity, other than in those liquid names, Tesla, Nvidia, those names that have a lot of options volume, in which case the weeklies are going to be strong and going to kind of carry you through.
I have a good question for you, Doc.
Okay.
So how can, which is actually a very good point, and thank you team for providing that. So how can this swing trading model for 5 days and 20 days be used to buy call and puts?
Okay, so
maybe we can
go back. Pull it up and we can talk about it.
Shall we go back to Nvidia?
Yeah, sure. Yeah, Nvidia is good.
And let me actually remove this 1 second. Okay.
Okay, so if we look at the lower green line, we see that it's going to pull back toward those lines, toward those levels, and that's where we would be looking to enter a long trade. Similarly, when we get to that risk trigger on the top, that's when, if I was looking to buy a put, I'll be looking to buy puts at or near a level up there. So just kind of think of it as how you might trade with any band, the Bollinger Band or any other kind of channel sort of trading you would do. And this just kind of gives you a better idea where you might want to enter and exit than just a channel. And I would advise using this in conjunction with whatever model you've been using. Some people, are using Bollinger Bands or RSIs or Fibonacci's, whatever you've used thus far in trading, consider this a complement to it. Now, I tend to use gamma levels as my main tool, and will kind of superimpose whatever TA price action I have on top of it. Other people might do it the other way and use whatever trading models they're used to and use this as confirmation. Did that answer your question? If not, I'll, let us know.
Yeah, and I mean, this is an interesting one. We see 100% in relation to lower band or upper band in some of the example, right? So the question is that, as we mentioned, the model is not just looking at technical analysis. We actually look at option data. So we're looking at like gamma, delta, like option Greek. So the example that we showed you, obviously the price of these assets have been trending to the upside, but like I'm sure if we go, I think yesterday, Doc, we had a good example. What was it, CMT?
CMG, yes, our dog. Full disclosure, I'm long CMG because Goldman Sachs restaurant analyst guru says go long. Our data says don't go long, but that's just 5 days out. So yeah, so CMG is an example where, go ahead, Fabio, you talk about the lower band there.
Yeah, so in this case, we're showing, an upper band. So that, in this case, has a bearish bias, right? So as you can see, the upper band has been shown on 7 days in this case. The lower band, even though the trend is kind of like sideways, kind of towards like a bearish trend, you see that the lower band still had an 81% success rate on those 27 days. So it really depends. I would say the answer, Doc, is it really depends on the asset, and it really depends on the data, like coming from the option market. So in this case, the bias is bearish. I'm sure we can do other examples like.
Now, if you want, just for fun, if you want to bring up the net DEX and the multi-expiry of CMG, and this is the kind of thing we talk about in the training room. I mean, we do screenshots of these, and yeah. And I tend to have my screen set up in a way that works, not the way I had it set up today. I'm not used to this streamcasting platform. Okay, so if we look up the net DEX of CMG, that's all expiries. You see the red put lines there are at 59, 57, 58. I can't really tell exactly what the numbers are, but their spot is at or below that. So basically, we're trapped down there in the red. We're trapped by those puts. We're trapped in there. Spot is now, what, 57, 55. Right. So we're kind of trapped by those puts. However, do you have the multi-expiry version? Now the multi-expiry is showing us different expirations. So if you look at the near-term expirations, you see all those red puts that were kind of trapped under. So market makers are short CMG stock against those puts. So the question, go ahead.
I think, one thing also here to note is that 50% of JAX is expiring on the 19th. So
which is exactly where I was going. Once those puts expire, either the people that bought them sell them for a profit to close or for loss because they don't want to take a full loss. And we can safely assume that people don't want to be assigned short shares of CMG. I mean, that's the other thing that would happen if you have an in-the-money put. Then you end up being the proud owner of a short position. Once those expire, all those short shares that the market makers have to hold to hedge the CMG get bought back. Suddenly, it has a good chance of reversing upward. We found some good trades like that with AMD when it was trapped below 160 a few weeks ago, 157 and a half, 162 in June. Once those puts expired, it started its new uptrend. So I'm hoping, betting since I'm long, that CMG, once these puts come out of the complex, into earnings, which are, I'm not sure exactly when, but they're in August somewhere. Earnings are coming up, and we see those green calls below in the lower quadrant, in the lower left quadrant. That no, the lower left, to your left. Yeah, once we see those calls up there, that CMG has a chance to accelerate up to the 60, 62.5, 65 level, and maybe Goldman Sachs restaurant analyst knows what he's talking about.
We have a nice question here. Are there 5-day skew or just 1 month? So as we mentioned, we are providing 3 skew charts. So the 1 month is the skew command here. We have a 3 months, and then we have what we call 0 DTE, but in the case of stocks would be the next expiration. So yes, we do have the 1 month, the 3 months, and the 1 week or 0 DTE. So if you're looking at SPX, you would get the skew for tomorrow's expiration or today's expiration. If you're looking at CMG in this case, you would get the next weekly expiration skew. Let me answer quickly, Doc. Another question. What type of bands are these? So these are not like related to technical, so it's not involving standard deviation or ATRs or Bollinger Bands. They're based on options data and also momentum factors, but most likely options data, gamma, delta, and other quantitative measures. So yeah, they are bands provided by leveraging quantitative models and options data.
So those are bands that tell us where customers are long or short puts or calls, which then tells us where market makers have an obligation to buy or sell the stock. Now, there's going to be areas in between where the options are kind of thin, where stock is kind of free to move, quote unquote, on its own based on technical factors or based on whatever else. So the largest open interest strikes are the ones that have the most weight.
Mm-hmm. All right, so let's see if we have any other questions.
And next time we do this, I promise I'll figure out how to have my screen shared in advance.
All right, so we have with the probability, so yes, so you are referring to our 1 day expected move. So let me just pull up the research guide. So yes, so that document is still on the website. Let me see if I can find it for you guys. All right, so this is actually a good way to show also. So as we discussed, we have a new website and we have a new learning portal, right? So you guys have now the ability to create a login for free, or you can subscribe, and you'll get access to all our guides. They were available before as well, but now they're a little bit more organized by product. So again, we're looking at the 1 day move indicator. So let's see, gamma levels, our 1 day move indicator, and then we have our backtesting results. So let's go here and see what the results are. 1 second. All right, so again, this is the 1 day minimum and 1 day max. We launched this last year, and then we did some really interesting results. So we're now working with a big quant firm, and we're going to come up with more backtesting in the next few weeks, months. So stay tuned on there. But essentially, again, the success in this case is how many times over the past 4 years does the price of SPX close above the 1 day minimum on the next day and close below the 1 day maximum on the next day. So the success rate is about 87%, 85%. if you were purely to do an iron condor strategy, the success rate was 72%. But again, that's a good question that I'm going to ask, Doc, is how do you, so you are doing basically iron condor every day, right?
Right.
What is
Okay.
the lessons that you want to like?
Okay. I have a few comments. For those of you that are familiar with selling iron condors, especially SPX 0DTE, there's a few things to take into consideration. First one is this success rate assumes that you're going to hold the short put or short call until the end of the day, and does it pierce that level? We often see a level get tested and a pullback and then continue in that direction. So the first thing is buy the close before the end of the day. I typically put in 50 to 65% of premium buy the close, in which case, even if a one-day max is, or one-day min is exceeded, I'm often out of the trade. Also, if you notice, the iron condor success rate is about 72%, 75%. Now this gets into a little into the weeds on iron condor selling. If you sell a 5-wide iron condor for about the third the width of the spread at these levels, even with that 72% success rate, you're not going to have big losses. You're going to be ahead. If you do what I do and sell 20 or 25 wide iron condors, then if one level is breached, you're going to have a large loss. And so how tight you sell the iron condors is going to dictate how much your financial loss is in relation to that. Also, markets consolidate about 80% of the time, which is kind of what this is showing us, 72%. It stays within those ranges. The other thing is you can often sell above and below the max min and the max between the one-day min and the one-day max. So that's if you go to those levels, but you can go beyond those levels and the numbers come out even better.
Yeah. Let me answer a couple of other questions. So the model is calculated as of end of day. So the data that will be available at the end of the day today will count for the next 5 days starting from tomorrow. Yeah, so you get the data soon after the close. It will count for the next 5 trading days starting from the following day. And then, Doc, this is actually a good question. How can you be able to determine market makers through position, like open interest doesn't always reflect the actual position of market makers? The answer here is pretty simple. Nobody can tell you that. There is no feed in the world that can actually show you the book or the portfolio of all the market makers. It just simply doesn't exist. So what does exist is the ability to access option data, option flow, and then be able to create models that can kind of like forecast with the potentially high level of accuracy that data. So that's what we do with our models. So again, we don't have a crystal ball and we don't have access to information that is not available, right? Which is the access to the book of the market makers. But what we do have access is option data, precise information, and then obviously we have a team of quants that develop these models that are fairly accurate for and our users can testify that, and Doc, you can testify that too. You were one of our first users.
Yeah, I've been using this since I was bothering him. When's the beta platform going to be ready? When can we get in there before it's even open? So yeah. And now here we get into the art, not science. As he said, nobody can predict, nobody knows. But what we tend to do every morning is look at the open interest, what I call caveman style, Back in the day, we didn't have a lot of this stuff. What we had when I first started doing this in the 2000s, whatever, was looking at the option chain. And so today, when we looked at the option chain, okay, oh, there's my little write-up for today. Scroll down, see if I put in a screenshot of the of some of the no, I don't think I put in the screenshot. I just shared it. We have 4,600 strike puts, large open interest, about 5,000. The assumption is that when we closed at 56.35, that those were probably customer long. We don't know, but that was the assumption. The assumption was at 56, at 56, 50, and 60, there was a good chance that there were longs and shorts and debit spreads. And so we expected a convex move if we got over 50 toward that 60, 65 level, and that's indeed what we got. And if you look at, what I wrote in the morning at whatever time it was, it's 5 o'clock, 6 a.m. If we scroll up to the if above chop zone, no, the other way, the other, let's scroll down, excuse me. Okay, above chop zone. So I identify a chop zone for today, which I think I said was 15 to 50. The narrow one, I gave a wider one. If above 56.50, yesterday's high of the day, I point out was 57. Then a test of 5,600 on Monday's high of the day. That's what I said. And where did we hit today? What was the high of the day? Let's take a look for fun, so I can show off. The high of the day today was, there it is coming up. I'm going to bet it was pretty close. And then I expected, then I give the next level. The high of the day was 56.63. Okay, so I expected it to stall somewhere up there. If we get over 56.60, it's a low gamma pressure environment. There's not a lot of hedging demand, possibly 70, 75 round numbers, stall area, but I don't expect that. And then I kind of go through different scenarios. So if you wanted to take a long or a short trade, you can use these scenarios. So the inner chop zone was 56. Let's scroll back a little bit. Let's see how I start my day here. Okay, the tight chop zone was 56.20, 56.50, broader 5600, 5660. And indeed, we held within those levels. Where did I get those numbers from? From the SPX trading view chart.
Yeah, so yeah, just to show you, like within the bot, you can get the levels, and then you can integrate them. Let me show you directly onto TradingView. 1 second. So all I need to do is copy the text, then come into the indicator. Yeah, and these are the levels for today.
And so the 1-day max was around 70, so that's where I got that from. And then 75 is a round number. Those quarter stripes are always, people, just humans tend to trade those levels, and that's where these levels came from.
Mm-hmm.
And then with those levels, the art of this is knowing what kind of hedging response do I expect there, and if a level is pierced, what that might mean. So piercing 56.50, those calls go in the money if they're long calls. If they're short calls, it doesn't matter because the delta flips, and then we get a convex move to the upside, which indeed we got. We get a nonlinear response when the deltas flip. Hope I'm not being too technical.
Mm-hmm.
And so, and you know, there's some people in here that have experienced that when I speak Greek like that, they know exactly what I'm talking about. And there's some people that say, whoa, wait a minute, what are you talking about? And we talk about it.
And we have a dictionary to
right.
translate your term. So I think, let me answer a couple of questions. So first of all, as part of the membership, you have access to our trading rooms. So we have 6 trading rooms. 2 of them are managed by Doc, the Iron Condor room, the trade structuring room. We then have a macro room, which is managed by Chester. We then have a scalping room, which is actually managed by your brother, Doc.
My brother, who actually was on the phone calling me before when I had to step away.
Then we have an option trading room. So again, here with the people, this is an open room where we discuss option strategies. And then we have a futures trading room where we're going to post our blind spot level, build the roadmap for today, and obviously the trade structuring room, which is where Doc would be active on a daily morning. We also have some voice rooms. So I think, Doc, you are pretty active there. You log in probably before the market opens. So around 8 p.m. 9
so my morning note, I mean, I'm usually up at 4 a.m., 5 a.m. So my morning note was finished today around 6, a little after 6. Sometimes it's finished by 5, rarely, if ever, after 7. I think I got done around 6:45 with my note. Those times that he's showing there, I guess, are whatever time zone he's in. That's why it says those times. But the note was done in the morning before the open. And in the option trading room, people discuss their trades. And some of the trades that we might talk about either in the structured channel or on the open mic, I'll put those trades in and I'll do them, not investment advice, paper trade only, and then I'll just put in what I do and how I manage them. Some winners, some losers. Happy to say more winners than losers. And there's a little tab in there where you can go to the results, trades that are closed and that are open.
Mm-hmm. Yeah. And there's a couple of other questions, Doc. I just want to answer this one.
Okay, sure, please.
It's a good showcase of, so if you were trading ES, S&P mini futures, would you use ES level, SPX, or SPY, and why? So first, that's actually a good question. So first of all, we are one of the few, actually probably the only company that is actually providing you with gamma levels on futures. So let me show you how this works within the bot. So within the bot, I can go here and I can request the levels, and we created a command, which is the futures command. In this command, we have SPX, we have NDX, QQQ, but we also have NQ and ES. So I can copy this text, and I can now come here, and I can go back to my indicator, and I can now replace this. So now we are basically plotting the levels of SPX but we also have the levels of ES. So this is the futures level. So if we go on ES, we now have the futures levels right here. But again, we can actually convert levels on the future or vice versa. So in this case, I can plot the SPX level on ES right here. So here what you can see is you have the SPX one-day max here, you have the SPX core resistance wall, and yeah, so you have the ability, I could even add like SPY here, so I can actually come here now and add SPY instead of SPX. So at this point, you are basically converting SPY. So,
And let me jump in and explain why somebody might want to do that. SPX has more notional traded daily, especially with the 0 DTE, than ES. And so the dealer's obligation, reflexive hedging response, what they basically must do if they don't want to lose money, is going to be strongest off of the SPX. And so with that conversion, you can see where the SPX levels are on an E-mini chart. So you don't have to make the conversion in your head and say, okay, it's approximately 50-point difference, whatever it is, and you don't have to play that mental game. You see where the levels are. And talk about blind spot while you're at it, even though I'm sure you're going to do a webinar on blind spot.
Yeah. So blind spots, they are available. They are posted live. We are soon going to have them on the bot. So they're here. So if we go back to our blind spot level for today, this is a strength code. And now we can go back to our chart. So then I can go back to my indicator and I can actually add the blind spots here. Actually, we need to add a second indicator in this case.
What is?
All right, and then we're just gonna take away the conversion here to just make it easier. So now we have just the levels plus the blind spot. But what we can also do here is if we want to remove those JAX level here, we have the ability to do so to make the chart a bit clearer. So now we have just the primary levels and the blind spot levels here. Yeah, so look how nice now the chart is. So tomorrow we're going to have a session with Patrick on blind spots. We're going to show you how to create a roadmap for the day, how to add them to the chart. So yeah, stay tuned there. All right, I think, yeah, so let me just, again, pull this up. So again, just reminding, today we're starting our promo for the month to join our membership. All this data, all the chat rooms or the trade structuring channels can be accessed through Discord. You can get access to Doc within his chat rooms and all the models that we showed you today. So yeah, so thank you, Doc. I don't know if you have anything you want to add.
Just parting words are that the more you use the different tools, the more you look at the multi-expiry or the trading view chart, the more you discover what works for you. It's the same data, more or less, but different presentation. And somebody's eye is just going to work better with one thing versus the other. Or somebody might be better able to integrate looking at a few different things. And the other thing that's great is it's a community. So some people are going to look at it one way. Some people are going to look at it another way. And then together we could do much more than we can do alone.
Yeah, and I think, yeah, exactly. So like if we go back and, let's show this again. So I think one of the things to highlight is that the more user we get, the more diversity of strategies are brought into the table, right? So we created a chat room which is called the blind spot level, where we have users that are actually contributing using their own method. So they're taking our gamma levels and then they are like creating iterations of their calculations. And this has really been helping the community, because then you get some additional inputs from different users that use a different approach. So for example, if you look at volume, there's like our user Killipips use like a very good volume approach, and this becomes very valuable. So again, the community, we have Chidai that has built like a conversion file. So like the community is really helping each other being successful and leveraging the tools that we have available for you guys. So there's still confusions on blind spots. Anthony, Jim, please connect tomorrow. If you can connect, the session will be recorded. But we are going to go into more details about what blind spots are and why they should be relevant for you guys.
But I'll give a brief preview. Things like, let's just say QQQ, Apple, large stocks are gonna, or SPX levels are still gonna have relevance on NQ or vice versa. So there's a way to convert what the unseen into seen, which is some secret sauce that Patrick and some of the guys cooked up. That's actually quite remarkable.
Yeah. Yeah, and I think, like, again, it's we're gonna share more information tomorrow, but it's more about having more information simplified in one single chart, so that you can actually get better insights, right? So because nobody really can manage to have like 10 I mean, you have 6 monitor, Doc, right?
I was about to say I can.
You can, I know you can, but the goal of this is really to simplify as much as we can, obviously with the data that is available, the read of the market, and these levels tend to work pretty well. So if we look at the futures trading, for example, let's see if we have some charts for today from Patrick. Again, like these are just plotting the blind spots, big retracement on one of the levels. Here we have NQ, right? Interesting chart. RTY, right? That's been great yesterday. We saw like a very good chart from yesterday looking at the blind spots. Yes, again, areas where there is a reaction, very, very precise. So tomorrow we'll chat more about blind spots. And then we're going to do more live sessions toward the end of the month. But yeah, like that's a very good point. Alex, how do I get access to the newest version of the indicator? For new users, it will be accessible through your portal, your account user portal. For existing user, we're going to post it later tonight in the TradingView channel on Discord. So stay tuned. All right. I think, again, Doc, really thank you for your time. Like, I always love chatting with you about your experience. And
my pleasure.
You're always up at like 4 a.m., sometimes even 2 a.m., like sharing your knowledge. I think you've been a great part of the community. Started off as a customer, but really, like, yeah, thank you so much for your contribution. And thank you guys for taking part. Great. Have a good day and see you tomorrow, guys.